Hello, everyone. Welcome to this edition of Shaping the Post-COVID World series. My name is Simeon Dyankov. I'm a policy director at the Financial Markets Group of the London School of Economics and also a research fellow there. With us today are Anne Kishel and Rabah Arezki. Welcome to both virtually at LSE, and we'll start the discussion followed by Rabah. Both of them have worked in the area of sovereign debt, financing, development for a number of years, and primarily from a private sector perspective, investment banking, sovereign advisory, starting with a number of the top companies in this field like JP Morgan, Rothschilds, and more recently Anne is running her own sovereign debt advisory from Paris that does a lot of work with African governments, so she would share some of her experience and thoughts. Rabah has a distinguished career in international institutions, spanning the International Monetary Fund, the World Bank, and very recently he has joined the African Development Bank as chief economist and vice president. So he has fresh perspective, hopefully for us, but also from his previous experiences and academic research, quite a lot to share. As I mentioned, this event is part of the London School of Economics series on shaping the post-COVID world. You can follow us on Twitter at #LSECovid19. Please send us comments during the talk as you have questions or thoughts. On user send questions here. It's the top user in the participants list. We would love to hear what you think and what are the types of topics that interest you. We will start first with Anne for an exposition of where the private sector is, where the governments in Africa are, and maybe even compared to some other governments in the world, since I should say both speakers have quite a rich experience in the Middle East, in Asia, in Latin America. So we'll have 10 to 12 minutes of initial presentations, followed by questions from all of you. And please, the floor is yours.
Thank you very much, Simeon, and thanks for the opportunity of this discussion. I first like to set the scene because I always think we need to consider things in background. So since the detection of COVID and of the first COVID cases in Africa, that was kind of like roughly mid-February, the number of cases rose to 1.5 million. So, and most of the rise actually has happened over the summer, with hubs identified around South Africa, Egypt, and Morocco. Actually, the virus seems now to be present in all African countries. Growth for 2020 is projected to contract by 3%, as expected by the IMF, and as a result of the COVID crisis, of course, but also because you had a commodity price shock affecting several commodity-intensive countries that you find in Africa. Lower activity, of course, due to the slowdown in global activity, as well as lockdown or social distancing policy also played a role to this number. This is the first recession in the continent in 25 years, and I think it's important to note. Capital outflows average 0.5% of GDP between February and May, and FDI's flows are also expected to contract, always difficult to kind of like have precise number, but between 25 and 40% this year as per the latest expectations. Capital outflows and the resulting currency depreciation are of course contributing to rising debt levels, while at the same time remittances are expected to fall drastically this year. And as you know, they contribute substantially in some countries to the revenue base. And its World Bank estimates that they point roughly around the 23% decline. I'd like to share another specificity in sub-Saharan Africa, which actually a lot of decision makers always like us to point out, because we try to forget it. It lies into the young population, because 70% of the region's population is aged below 30, which actually means that they may have different patterns of behavior toward the pandemic. And this is, of course, something also to consider, while at the same time, it means that it's difficult to predict because there is this particular point. Actually, I also like to share that the pandemic is expected to wipe out, it's difficult also to precisely know it, but roughly 20 million jobs in Africa, which is obviously a lot. This means that it puts a generation at risk of decreasing earnings, job losses, and reduced learning opportunities. And actually, the fact that also a lot of kids and students are out of school and out of education is actually also a huge problem that the continent is facing. Actually, the world is facing it, but in particular the continent, as they didn't have all the digital material typically that we can have and we can see in other regions. And actually, I also want to share, because it's a very important point for me, that 43 million more people are at risk of extreme poverty in sub-Saharan Africa, according to World Bank. So clearly, we see, and that's the reason of those numbers, the risk of the pandemic into potentially what could be, if the right decisions are not taken, a lost decade. But I'll come back to this. But first of all, and it's also an important point to note, several countries in the region have entered the crisis with limited room to maneuver to handle the crisis. And the reason for this is that most of them were speeding up a lot of their developments. We're making a lot of its investment in infrastructure, in digital. So actually you had seen that level rise substantially before entering into the pandemic. This is also another fact that one needs to bear in mind. Let me also give you some examples. Typically, you see some deteriorated fiscal position and small room to maneuver to finance those fiscal packages that actually are absolutely needed to support the economy. And it makes it difficult without cutting capital expenditure. As you are starting from bases like in 2019, you had fiscal deficit in Ghana and Kenya roughly around 7.4 or 7.8% of GDP. So it's actually very, very high already, so difficult to have more room to maneuver. I also like to point out that at the end of 19, the public debt to GDP ratio overall in the region, in Africa, was 50%, which reflects the substantial rise since 2008. And as you will remember, there was before a very sharp decline in the 2000s, because of the EPIC debt relief initiative. So you had this decline and then this substantial increase, in particular after 2008. That is also another thing that we have to bear in mind into all what we're thinking here. Debt is rising, but most importantly also debt is changing its composition. And this is also another very major element of the overall discussion that are currently happening on debt matters, because you have an increased reliance on commercial financing, which also means higher debt service cost, because obviously it's higher than concessional debt. In 2000, bilateral and multilateral debt accounted for almost kind of like 90% of total public external debt, while in 2018, it was about 50%. So you see a very sharp decrease, hence a very important increase of those commercial lending. As we all know, issuance in particular in the capital markets have become extremely frequent, with countries issuing both in dollars mostly, but also in euros, and some countries really developing some yield curve already. So which means that they kind of like were frequent issuers in those capital markets. Nigeria and Ghana, for example, have been the largest issuers over the last 2 years. And then you also had some bonds from Kenya, from Cote d'Ivoire, from Senegal, where basically they kind of like raised each time several billions and have in the market several billions altogether in euros and in dollars. In addition, and it's also been to be noted, because when we look into debt to GDP, we look into debt, but also GDP, several countries in the region have rebased their GDP over the last 10 years, which kind of like is good because it contributes to a more accurate picture of the size and composition of the economy. But it also shows that this exercise has been done, hence that the number of debt to GDP that we have right now are close to the accurate number when taken into consideration all the different pieces of the economy. Also, as a point of reference, as of September 19, the total rebasing exercise in the entire region led to an increase of the size of the sub-African GDP by 13%, also to put numbers in perspective. So with this element of context, what did happen after when the COVID hit? It has to be said that the African government responded quickly and in innovative ways for them, with a specific target to kind of like help the hardest hit in the population. You had, for example, some fiscal packages that was part of the response that they put together, and they roughly average 3% of GDP, and roughly kind of like 75%, three quarter of them were dedicated to health spending, according to the IMF. In some regional zones, like for example in the UMOA, convergence criteria were of course suspended, as it was also the case in Europe, in order to kind of like leave fiscal space, in order to kind of like restore and leave a little bit of time to do some spending before you restore your finances. It's also to be said that central banks have eased monetary policies. This is something interesting in Africa, but also overall in the world, because you had seen quite a different behavior from central bank, in particular from emerging markets, because the kind of like US or ECB took some stands that were already taken, maybe pushed more, but in 2008 during this crisis. But emerging market actually for the first time took also some very strong actions, and more and different than in 2008. And typically there were a lot of rate cuts. I'm thinking like Uganda, South Africa, for example, Ghana, and of course also the two monetary zones that basically decided to cut rate. Some also decided liquidity injection, was the case for Angola and Nigeria, for example. Also interesting, the government took quick action to support business and household. So it was interesting to see that they were both, and actually they tried to kind of like target them to the hardest hit. It's expected to say that they spend an average kind of like 2.5% on GDP, especially on health and social spending. We could talk a lot about examples. I think one is interesting in Congo, that is a cash transfer program, Novici, that was put in place for those impacted of the COVID. There was also in Côte d'Ivoire an interesting program with a response plan to farmers that was interesting, with kind of like income provision that were given. And in Zambia, there were something particularly targeted to poor women that kind of like was a program that kind of like worked well. So of course now one needs to think how to finance those response plans and the resulting increasing deficit, and how is the international community going to act and going to help. Actually, it has to be said that the multilateral organizations have responded substantially and quickly to meet the increasing funding needs and to free up budget space for funding response. The World Bank dispersed close to 21 billion in lending, and kind of like almost 900 million in emergency health operation to provide medical supply and other devices that were basically needed. The IMF finances a lot of envelopes. Years to date, we expect a disbursement. We measure them as being roughly kind of like 30 billion, 26 billion to be precise, which means that it's 10 times higher than the average of the last 10 years. So substantial effort from the IMF. And of course, also the IMF supported, took part, and of course the World Bank also, as in the G20 initiative, that basically kind of like allowed for debt suspension mechanism, and the famous DSSI initiative that is currently very, very discussed during the IMF days. Why it is discussed? It's discussed because people are thinking, should we continue it? For how long should we continue it? And should, which is a big debate, the private sector be included in this initiative? Should they on a voluntary basis? Should they in a forced or mandatory basis? And if it's mandatory, how and what are the means in order to make it mandatory? Is it actually doable to make it mandatory? I mean, those are the questions that are actually being heavily discussed, heavily contested, also as is the result so far of the DSSI initiative. You have sort of two camps. You have one camp that basically say it was absolutely necessary and praise the G20 initiative, even if some say, okay, some parameters could have been made clearer, in particular around the NPV discussion. And you have another school that basically say that because of this initiative, actually, you had the possibility for 73 countries to take part in it, and actually not all of them took part. And some say that the fact that not all of them asked for this initiative shows that it was not a successful initiative. I actually believe that this initiative was absolutely necessary, and that of course you cannot, the numbers are, always mean something but don't mean as much, because of course if you're a country with a lot of concessional financing, you of course are going to apply to this initiative and it's gonna give you substantial relief. If you are a country with less concessional funding, you are in the dilemma of thinking, if I take the DSSI initiative, Is it going to increase my spreads? Am I going to be able to go back to the markets? And some countries made this decision, for example, Kenya, but you can also name Honduras or other countries who basically decided not to take it because they were afraid actually that the spread and cost of financing going forward would increase, and it would make almost market access not possible. So a very interesting debate with kind of like, frankly, heavy discussion, lots of examples being given, some of them out of their context, so you can make facts say different things. It's actually much more tailored with regards to discussion than anything else. So now what should be done? Because this is now what's interesting. Clearly we're entering into second phase or phase post the crisis phase of response to the crisis. So it's now time to design exit strategies and recovery plan in order to think more medium term, basically. And clearly there are some actions that needs to be taken. In particular, as the IMF expects 1.2 billion gross financing needs over the 2020-2023 period, which most of which is debt amortization and also current account deficit that needs to be kind of like funded, basically. So there is a huge funding gap, and how is this funding gap going to be solved? And that's the whole question. So now let's kind of like think, as I said, innovative solution. First, clearly, all countries in the region need to increase the diversification of their economy, and they, of course, need to move the global value chain. It's very obvious that if you just sell raw materials, I mean, you can have less of a margin, and then when you kind of like have added value products, it's clearly the issue in a lot of African countries to develop those, and it absolutely needs to be worked on. You have, however, success story like South Africa, Ethiopia, of course, Tanzania, that have clearly moved up this global value chain over the past years. Those success stories needs to be promoted and needs to be replicated, in particular in the countries that have kind of like raw materials, goods, commodities that needs to be kind of like put further into the global value chain. Second, of course, is the challenge of informality. As we know, the informal economy accounts for more than 35% of GDP. And this number, as every number, shows a lot of not homogeneity, because clearly it can be less in countries, more in countries, and you do have some, typically in Nigeria or Tanzania, that have more than 60% of informal economy, 60% of GDP, of course, being informal economy. So it needs to be tackled, and this is kind of like one of the very important problem and program that needs to be put in place. How? Certainly to reassure workers that are going to transit into the formal economy that they would be supported and that it's beneficial to transition between informal and formal. And also, of course, which is one of the important points, they need to have access to financing. So formality needs to give you advantages, like typically indeed have some capacity to have credit that basically is going to be helpful to develop the economy. So this means that basically, as I said, it also requires some financing options that are innovative. So, as I said, the access to credit is limited. More needs to be done for the SMEs, either through guarantees, either through pools of investors, dedicated financing, but also teaching the access to credit and giving some clear paths or very simple paths to entrepreneurs to know how to access the credit market. There is currently a very interesting study that is being conducted and will be reinforced in Ivory Coast on this, because Ivory Coast has all the ingredients to basically have more SMEs being more developed and growing, but actually there is a disconnect between this potential and the access to credit, as the banks mostly fund the government in the sense of they buy a lot of local domestic debt, which is certainly good for them, but they do not play an enough good role in the economy, and they don't have all the processes and all the method in order to also analyze the credit, as well as the entrepreneur don't also really know how to present the case in front of the banks. So it needs to clearly have a dialogue between potential lender and SMEs in order to foster this and make sure that they ultimately get access to credit. Of course, also microcredit initiatives are more than welcome. there are some very interesting cases that are highly successful. And I like to quote one on which we've been working. So maybe not, I'm not objective, but I think I am, which is the DARE, which is a rapid entrepreneurship delegation in Senegal, that actually is dedicated to young people and women, and that I think had a great success because in kind of like 18 months was able to deliver funds to projects in every single village of Senegal. And it was done in a very constructed way, and also in full line and coherence with the Senegal Plan Emergence, or the overall vision of the economic plan of the country. And as I said, one last point there, it's the cooperation between public and private. Because I hear a lot of entrepreneurs in Africa who basically are saying, actually, sometimes we receive help from government, but this is not helpful to us because in theory, it's a good idea. In practice, it's not a good idea. So actually, they are very, very keen to have a much active dialogue with the public sector so that they can give feedback and so that they can also contribute to solutions that are actually matching their needs. And every solution is very different by country, typically. Also, and finally, the crisis is a tremendous opportunity to increase the push towards digitalization. And we know that Africa is already very advanced, but needs to be even more advanced. And clearly, it offers a lot of opportunities in several sectors. So as concluding remarks, it's very important not to turn the crisis into a lost decade for Africa. There is a risk of it, but being optimistic, I think that we will be in a capacity to avoid it because we know how to avoid it. I would like also to say that Africa remains underfinanced and under-indebted. In fact, despite what is said around it's over-indebted, some countries have too high level of debt and they need to reprofile it, to restructure it, but actually much more is needed when it comes to investment. And there is money that can be put at work. You need the right channel in order to have this money effective for the population. And I also like to say that, of course, this crisis shows some structures and structural reforms that need to happen in Africa, and we need to learn those lessons in order to make sure that they're immune for any of similar type of crisis if they ever were to happen, learning lessons from this. Thank you.
Thank you very much, Anne. Great initial remarks. We'll go to Rabah, but while he speaks, please think of the first question that has come for you. So you mentioned that multinationals like the IMF, the World Bank, some of the regional banks have done very well at the onset of the crisis. How do you see this developing in the next few months and frankly maybe years as we move to recovery? But now with Rabah, who, as I mentioned, just recently moved from the World Bank, one multinational, to one regional, the African Development Bank, but also does a lot of research on this topic. Rabah, the floor is yours.
Thank you very much, Simeon. And Anne-Laure did a very good job at I think, telling you everything I had to say. So I'm going to try and say it a bit differently. So I wanted to divide my talk in a chronological manner with three parts. First, talking about the attributes of African economy prior to the crisis, and then talk about the what happened during the crisis, and then look forward. So I'll do just a tiny bit of that, and then maybe I'll touch on a chapter that I'm writing for a book we are co-editing with Simeon on the future of development banking, which I think addresses some of the questions that were raised already. So as Anne-Laure said, prior to the crisis, this crisis was really a crisis of lack of preparedness. And of course, lack of preparedness, not just for African countries, but all around the world, including advanced economy. But where Africa stands out is that there are still very severe shortages in terms of health infrastructure, including basic care. And that's where that's where the issue really is quite dramatic for the continent, and speaks to the issue of prioritizing Africa's building of resilience in time when financing is drying out. So the issue of resilience and the issue of financing are going to loom very large in the continent, and COVID has really, again, made that very clear. So the other attribute of African economies is really the dual and polarized labor market. And again, there are heterogeneity across African economies, but yet we really have on the one side the workers that are working hand to mouth in the informal economy versus the other working in the public sector or state-owned enterprises or large domestic and foreign firms. So this really created the kind of tension that was there before COVID, but was exacerbated given the lack of access to social protection on the part of informal workers. And of course, these tensions are also to be seen in the flare-up that we see with protests that are re-emerging in different parts of the continent. So this is a continent that had low social and financial buffers, and on top of that, had elevated level of debt. So it arrives at this crisis with running very low on buffer. And I'd like to add that in addition to the COVID shock, the continent also faced other quite catastrophical events, including the locust crisis, which is devastating agricultural production in East Africa, but also is spreading in the Sahel and other parts of the continent. So another severe shock threatening the continent food security. And of course, the other shock, which is which is related to COVID, is the commodity, the oil price shock. You may recall that the oil price turned negative during the year, and of course, with the recovery of China, that the commodity price are recovering somewhat, and of course the fate of the commodity market is going to hinge upon what's happening in China, considering the large share of commodities demand coming from China. But coming back to COVID, and the epidemiologic curve has flattened somewhat after a peak in June, but there are still some flashpoints, as Marino pointed out, in South Africa and Northern Africa. And what's concerning here the most, on top of the casualties, the death, and the human suffering, is really through the indirect effect of COVID, through remittances, tourism, and FDI, of course, and the new normal on FDI, on tourism, on remittances is really quite worrisome. And the gross estimate that we had were negative double-digit for tourism-oriented countries such as Mauritius, Seychelles, and others. And these are closely followed by oil exporters, who are also been quite severely affected. And then we had also some more positive numbers for oil importers that are least affected, like Rwanda and others. But the financing gap is enormous. The African Development Bank estimate for 2020 that the financing gap is north of 100 billion. The IMF managing director just came out with a staggering number of 350 billion gap in financing through 2023. So the needs, the financing needs are huge, and the recovery is thus facing lots of headwinds, with lots of potential bankruptcy on both the financial and non-financial side, and with lots of contingent liability that are likely to emerge at the time we need it the least. to think about financing need, and I think Anne-Laure again did a great job at trying to think creatively about that. I would think that a combination of domestic resource mobilization, but here not understood just as a tax revenue mobilization, but mobilizing saving, including by fixing, so to speak, the financial system, is going to be critical to tap into both foreign and domestic saving. Lowering the leakages, including related to capital flight. This is a severe issue in the continent that we see enormous capital flight. So the imposing of capital control is going to be a very important tool to try and avoid that these important leakages that are emerging. And of course, some element of monetary policy, provided that inflation expectations are well anchored, could also help. But there again, the ability of African economy to replicate what we have seen in advanced economy in terms of QE, quantitative easing, is going to be quite challenged by the fact that if monetization, straight monetization is implemented, there is a risk of fatal currency mismatch that would then lead to a disorderly adjustment both on the exchange rate and inflation that would and possibly hyperinflation that would come out of this type of policies. So there are a number of countries that, again, Anne-Laure mentioned, that strategically borrowed from the market at relatively decent rates. Egypt is one of them, and of course, these are important moves, and they're welcome, but they also speak to the issue of what's been done with the money. So many countries have reduced taxes, they've postponed VAT, they've postponed the payment of electricity bills, water bills. They've also done a lot of cash transfer supported by Development Bank and other international financial institution. But again, the issue of leakage is there. The leakage is here linked to corruption, linked to the issue of lack of competition in several sectors, including the import sectors, are going to be the type of reform that are going to help create some fiscal space at the time when we need it the most, both on the health side, but also on protecting livelihood through this cash transfer. So the countries will have not to consolidate across the board, but really look for any source of leakages, including, as I mentioned, the capital outflows, sometimes illegal, related to illegal activities that are coming out of the continent, that has been documented in ways that is really a staggering numbers there. And obviously, there are also issues related to state-owned enterprises, who are a very important source of leakages. And it is indeed the appropriate time to consider reforming, revamping social protection in ways that is more universal, but at the same time allow to do the reform that were needed to have a more equitable and less dual labor market. Looking forward, indeed, I won't go back on the debt issue, but a lot more needs to be done than the G20 initiative, which hopefully will be extended. But decisive action on the debt front, debt relief and debt consolidation are going to be important to avoid the debt overhang. But of course, countries need to restart growth. They need to get the recovery underway, and that's going to be the possibility of having that Schumpeterian moment where one could really, both on the safety net side, be a lot more universal, but at the same time really bring an end to that dual labor market by having the informal economy. Increase in productivity, including through digitalization, but also including through access to markets and access to credit. I'll finish by mentioning some of the elements that I I put together in preparation for the chapter that I mentioned, coming out in that book on financing the recovery for Africa. In thinking about development bank and international financial institution, they did act early, yet of course very quickly they hit limits to how much they can provide in terms of financing, and this limit is unlikely to change in the short run. And so it is quite important, again, as in thinking about the relevance of development banks and international financial institutions, that while they were created in the aftermath of the Second World War, they were then the main game in town. They were very important. They were a sizable share of aid, was a sizable share of capital flow. It was, I calculated that multilateral aid was about, in the 70s, was about 20% of FDI. I guess much lower when you consider portfolio flow as well, but clearly they were quite that main game in town. And fast forward today, they have become a much smaller portion of that private capital flows, and as a result, they need to rethink their mission in ways that they catalyze much more the resources that they have at their disposal. And I see three important levers that can help them catalyze these resources for Africa, which have to do first with on the policy front. They need to embrace much more the push for regionalization of the economies of the continent. And as you know, there is this important free trade initiative, but the COVID has again accelerated some of the earlier trend on regionalization, and it is important that Africa doesn't get left behind, and creating or helping create a single market would be attractive to foreign direct investment and allow a lot more trade within the continent, and in addition would allow to position the continent well in this regionalizing world. The second point is related to something Anna mentioned, is the issue of resource mobilization. International financing institution, while important in relevant when developing a specific project, they could be advised to do a lot more by trying to fix financial system and orient them toward channeling saving toward more productive investment. And there the issue is, I think, twofold, is that many of the countries in the continent still are suffering from this sort of financial repression, whereby banks mostly are financing the government. And of course, because of the type of regulation they're under, are also somewhat shielded from the competition of non-bank operators. One revolution that's coming in the continent, and Nigeria, Kenya, and some other countries are leading the way, is the fintech revolution, which is one that really has the potential to completely change the scene of finance in the continent. Yet, of course, banks are very important lobbies and are indeed resisting still in many parts of the continent. And in North Africa, for instance, I had myself difficulties trying to convince central bank governors to embrace digital payment and the advent of this non-bank operator in providing this important function of payment, digital or mobile payment. So clearly, in addition to the payment function, clearly that resource mobilization, that identifying of risk, that to be able to channel that saving, whatever it is, toward investment is absolutely critical, and will allow international financial institutions to act much more upstream and allow to catalyze again, domestic and foreign saving. For a lot of the projects that are needed in the continent, including for green finance, a lot of the instrument, including currency swaps and other instruments, are not available. So even so, foreign companies or foreign investors would be interested. The banking sector or the financial system is ill-equipped to allow for this large financial transaction and to provide the kind of risk mitigating instrument that are needed to deploy these investments that would be highly profitable. The third and last lever I see as important is obviously, but it really rests on the other two, having a much more regionalized continent, having a financial system that channel saving toward investment more effectively, as opposed to being a rentier sector mirroring the economies, is the issue of of course, private sector development. And there, a lot of development bank, including the World Bank, including the African Development Bank, have moved toward that so-called cascade approach, whereby the funding to government is not provided only when these upstream reform or guarantees are not deployed. So clearly, that notion that catalyzing private sector development, it should be at the core of this institution. It is there, I would say, in terms of the big ideas, but the implementation has been challenging. And to conclude, I would argue that, and that would be a question that I have for Anne-Laure, is that there is a lot to be done in thinking about the type of instrument and the design of this instrument to try and get that private sector focus much more present and much more effective at deploying that private sector into the economy. And in thinking about this type of, the design of this instrument, for instance, could be the development bank articulate objectives such as the amount of private sector being leveraged as the objective of concessional lending, in order to really align these big development goals and try and trigger a lot more of that private sector finance, as opposed to really be focused on the type of project that are important but not transformative in many ways. So in some, we should, in development banks, try and make big idea meet the kind of more operational side of this institution. At the moment, I can see quite a divide between the big ideas and relatively small projects. So finding ways in which we design instruments to reconcile the two is going to be critical for development bank, but it's also going to be critical in thinking about debt restructuring, where state contingent instruments are also going to be a way forward. I'll stop there. Thank you very much.
Thank you very much, Rabah. The book that Rabah mentioned is forthcoming in January of 2021. It's a joint initiative by CEPR Vox EU in London, the Financial Markets Group in the London School of Economics, and the African Development Bank. And both Anne and Rabah and myself actually are contributors to that book. It precisely wants to bring attention to what is specific about Africa, what is specific about development institutions and the private sector working there. So stay tuned in January 2021. Rabah, one set of questions that is already coming for you after we hear from Anne is the role of both state-owned enterprises you mentioned, but also state-owned banks. You mentioned the banking sector and the lack of innovation in some countries, but lots of innovation in others. So you can start thinking about, in this crisis, some governments seem to be using both the state-owned banks, but also increasingly SOEs to either reach particular parts of the population or the private sector? Does this allow us to have a new view on state-owned banks, state-owned enterprises, and how, in your view, would this develop in the post-COVID recovery? Now, and there are actually two questions related to you, so please consider them jointly. So one that I posed to you, and now a couple of our commentators as well, is what is the mix going forward between the development institutions, bilaterals, multilateral, regional banks, and the private sector? You mentioned that the institutions have been quite significant in the early months. Is this likely to change? And then the questions that Rabah mentioned, and actually a number of our participants as well, is this time for new instruments, either from the private sector side or from jointly with some of the institutions? Green finance was mentioned. You've worked a lot in this field of innovative instruments. Can you please discuss these two questions?
Sure. Thank you for those great questions. So with regards to the first one about the mix, it's highly interesting because indeed, while the IMF and frankly, all public partners have been there substantially in the first phase of the crisis, it's also true that they are reaching to some extent some of the limit of what they can do, because actually you need to provide, and they need to provide the funding, of course, to help throughout the crisis, but they also need to provide the funding for the usual traditional projects that were anyhow going on before the crisis. So the accumulation of both needs is something that kind of like will make their capacity to lend kind of like, challenged, I would say, unless there are some broader reforms when it comes to either the IMF, it's a famous SDR discussion that people are having with the US veto for the moment, but other innovative ways of how to deploy more the IMF funds is in discussion. There's also the famous debate around guarantees, because, and this is more for World Bank and also development banks, basically you can expand your balance sheet by kind of like providing guarantees versus providing direct funding. Those guarantees can substantially help decreasing the cost, and this may well be a very effective way to kind of like use the development bank, World Bank balance sheet. I'll come back to this because there has been some examples either through projects, some Asian projects that are highly interesting, typically Benin, that also was able to kind of like reprofile its shorter debt at the time in 2018 into longer debt. It was domestic debt and did it at very attractive rates through and with the help of a partial guarantee from the World Bank. There was also the controversial Ghana bond issuance whereby there was a partial guarantee provided by the World Bank. Why controversial? It's because this bond was issued at double-digit numbers, which people said, well, with a World Bank guarantee, they still managed to come to the market with 10%. This is wrong. Actually, and this could be an all-over debate on this one, but actually the choice was between kind of like them not accessing the market at all. There was no price for Ghana at this time, or them being able to access the market. You do have a school of thought that says that Ghana should have defaulted at the time and that it would have been much better for the country. So it's still a very heavily debated topic within professionals. So yeah, there will be a challenge in the public financing that is provided. We discuss multis. Of course, it's going to be exactly the same also for states, because bilateral lending, while it will still continue, but I mean, countries themselves are going to be very careful with a budget that they're going to affect to development. And they actually also going to have to kind of like think differently around development. And maybe I'll come back to this also in the second questions with innovative instruments. But typically, if you already take the Gulf countries, which were actually substantial provider of bilateral help to countries, they are actually very active players in the DSSI initiative, but you can see that from themselves already they are shrinking some of the budgets. So why are they going to do this for themselves and not for the others and for development? For sure they will. So there is going to be some kind of like not maybe shrinking is not the right word, but at least some diminution or maybe some more selectiveness around projects that are going to be funded from the public sector. So this means that the private sector is going to play an increasingly important role, which is neither good nor bad, but kind of like poses three questions. First, the cost, because it's very clear, concessional, not the same rate at all. And then obviously the burden on the finances, on the interest side is clearly something that you have to consider in a budget. And you may well kind of like decide that you don't want this, or you want to try to avoid this and deploy funds elsewhere. The second thing is that actually those investors may potentially also become and put themselves in a position of strength vis-a-vis a country. And you may want to be extremely careful with whom you place your paper, because in a case of restructuring, you don't have the same investor behavior. And it's not just the hedge fund versus the traditional buyers. Even with the traditional buyers, not all of them have a constructive attitude. So this also is a kind of like important point. And lastly, there will certainly need to be some new investors, and those new investors typically can come through sustainable funds, and this leads us to the second question, but typically those could be ultimately, if the market is working well, those could be funds with kind of like bona fide rates, if you want, that can actually be cheaper, not concessional, of course, but cheaper than your traditional lending. For the moment, it's not really happening because the rates are roughly kind of like the same. You need the market and you need time to develop in order to see this difference, but it would be healthy that we see this difference. And exactly also to Rabah's point, I mean, it's very important to think about the development bank. They are key. It's true that sometimes they do have limited means versus the capacity of what they could be doing, but actually they are the ones who know what's happening on the ground, which kind of like which project is good to be financed and how to kind of like finance it the most effectively. So for sure, at some point it will raise the question of potential capital increase, which is happening in some development banks around the continent, or also of other means to better deploy and more efficiently deploy capital. Going back quickly to your second question on innovative instruments. Look, there are so many ways to be innovative. Of course, you can do sustainable, green, social financing. And actually, the EMOA zone was pretty good in issuing some social bonds during the crisis, and they were hit with a lot of demand. So this was a kind of like good or interesting initiative. But even before thinking about this, all of those countries actually would need to have domestic developed market as well as access to international market. And the domestic market is extremely important. And there is a very strong case study that one can make that countries who do have developed domestic market actually survive much better through the crisis, because actually they're able to manage the flow much better, and they actually don't have to face some very sudden outflows from people who would not kind of like be knowledgeable about the country. So developing local domestic market is extremely important, and that's also the reason why it's so important that typically, I'm talking about UEMOA zone, but there can be of course other examples, they can attract international investors so that at the end of the day, those local markets develop themselves in the right way, because they are the ones who are going to ultimately also be used to finance the economy. Then, as I said, green, social, those are extremely good initiatives, can be even more structured with a lot of features, also with, as we said, partial guarantees. Not everybody is fan of partial guarantees. Some people don't know how to price them. So let's see. But I like to kind of like finish the answer with two ideas. The first one that indeed Rabah also hinted to around kind of like state contingent liabilities. Clearly, if and when there are going to be some restructurings, and we know those will happen, there may be a trade-off between the haircut that an investor accepts to take and the kind of like risk sharing of the return to better fortune as a growth going forward. So typically things like GDP linked, I mean, could be good instruments. Not all investors are able to buy those instruments, but this could be potentially something that one can be working on. And lastly, and this is not as mentioned, but is highly important, you can have instruments such also as diaspora bond and diaspora instruments altogether, which actually are also something that people would need to think of. And it links back to my point around some of the large donor countries shrinking at some point, they help. So you would need to be much more innovative around the way that you manage the flows between the country. And certainly this angle and this axe can be developed much more in terms of debt, in terms of revenue, in terms of transfer, you name it. But it's certainly an avenue that certainly should be much more exploited.
Thank you, Anne. We got a question for you after Rabah on diaspora bonds. So this sounds interesting. Has it been used somewhere in the past? Can you just explain a bit how this may work? But first, Rabah, and difficult question on state-owned enterprises, state-owned banks. What's the future? They seem to be quite used by some countries in this recovery period. Is this a positive development? Is this a good chance for them to be modernized, so to speak? Rabah, please.
Yeah, no, thank you. No, I'll be short. So what was private before the crisis is likely to become public. Think about the airlines, and this is in the advanced economies. But the question that I have is, I mean, the way I look at that question is really that many developing countries are at a different end of the spectrum of advanced economy, meaning that a lot of developing countries in the continent had already an economy that was dominated by state-owned enterprises, and I'm thinking quite a bit about parts of North Africa, but also elsewhere in the continent. So clearly there, the question becomes: is this again a Schumpeterian moment where you take the opportunity to revisit the dominance of the state in the economy, and that is crowding out access to market, access to credit, and is behind the dual market that we see. So while it is appropriate in the midst of a crisis to avoid liquidity turning into solvency problem, to have the state take over companies, I would still take a hard look at what I think is the ultimate criteria that we should care about as to whether bailout should be involved is capability, meaning capability preservation, to the extent that the company has capability intrinsic, and it's having liquidity problems that are turning insolvency. I would argue that the bailout from the state it would be appropriate, but if it is to save the employees or the worker or household in general, it is quite important to have separate instruments so that we help directly worker and household, and not continue in the path that we've been taking in certain countries where we have crowded out genuine private sector development in area where the state has nothing to offer. So I'll stop here. And of course, public banks, state-owned banks, are a very good example of that. Learning from the global financial crisis, the many countries in the continent have refused to privatize some of the bank, arguing that U.S. banks are assigned that private banks are too risky. But of course, again, there are different ends of the spectrum, and the U.S. could afford bailing out its bank while it has a robust private sector-led economy. While I really think that in many countries in the continent, it's the moment where we think more holistically about this dual labor market and stopping the crowding out while attending to the livelihoods of the population and the workers.
Yep. Thank you, Rabah. While we listen to Anne, and diaspora bonds, are they used in the past? How do you go about it in this crisis? A couple of questions came. Questions seem to be converging around a few topics on the energy sector. So you mentioned that as part of crisis response, a number of governments in the region, and actually in most regions in the world, have postponed energy bills or subsidized energy bills, both for companies and for households. This is after a decade of trying to tighten budget constraints on mostly state-owned energy providers in the region. Do you foresee an issue going forward with the energy sector in these countries? Some of them, of course, produce energies, others importers of energy, but the energy sector and how is it going to fare during the recovery period? But now to Anne and diaspora bonds. There were 3 or 4 questions related to how this work.
Sure. So first of all, let me say it has been done in the past. And actually, while you had very kind of like large issuers, which are Israel and India, I'll come back to this, that kind of like are the largest issuer of those bonds in the world. Actually, you do have examples in Africa. And I'd like also to kind of like mention them. Nigeria and Ethiopia in particular are the ones that I like to mention. And of course, you have a lot of countries that are thinking about it and working around it. And also, I like to say what is needed for this. So just to give you an example, because we're not talking about large amounts, but kind of like India and Israel have issued those very, very, very kind of like frequently for a total of roughly, on the top of my head, kind of like $40 billion US since they kind of like started this process basically. And this has been highly successful for both countries for a single reason of a lot of engagement with the diaspora, because actually for this diaspora bond to work, which means for the diaspora to accept to place their money into a diaspora bond, because that's the way it's basically kind of like worked. So you are part of the diaspora, you accept to fund your country through subscribing to a diaspora bond. In order for it to work, there need to be first strong links between the country and its diaspora, which is not obvious for any country that does have diaspora outside. Second, of course, and I should have started by this, your diaspora needs to be sufficient enough when it comes to numbers and of course wealth also of the diaspora, because otherwise it's not worth it. 3, they need to have extremely good governance, a little bit like, you know, the green or the social bonds. You need to kind of like say to which use it's gonna be going. And actually you need to also have extremely proper governance around the funds are going to be used to this. I'm gonna show you the result of what of the funds that you've been dedicating to this bond. So this also is something very important. Use of proceeds, the focus on use of proceeds, and also going forward kind of like follow-up and feedbacks around where this money has been going. And this is the only way to kind of like make it successful. You also, but I'm not going to bother you with this, but you need to be very careful with also the format of the bonds, which were some of the issues on the Israeli bond that kind of like were very illiquid, so very difficult to buy back, because, you know, sometimes some people want to kind of like get rid of those bonds. So how do you do, and how do you organize a liquid market? I'm not going to bother you with this, but the technicalities that you need to be kind of like mindful of. In 2017, actually, Nigeria, very interestingly, issued kind of like 300 million of a diaspora bond. So you see that the amounts are not as important as what we mentioned initially, kind of like Ivory Coast, Senegal raising 1 billion plus type of bond. So you're talking smaller, you're also talking 5 years-ish, so you're not kind of like talking, you know, 20, 30 years, but still you're talking about substantial size. And in the case of Nigeria, it was to fund kind of like infrastructure projects, basically. So it was, as I said, identified. Interestingly, the coupon was 5% something, I think 5 to 65, versus if they had been kind of like borrowing in the market, it would have been kind of like 7%. So it's an attractive way to also kind of like fund yourself at an attractive rate, while, and the reason why you can do this is that it's obviously your own population, so they're kind of like taking part, I would say, into the effort. So you have a patriotic somehow sentiment in order to kind of like take part of those bonds. And that's interesting because when you think, and the emotional affiliation, of course, of a diaspora to its country, it's also very, very important. Interesting, Ethiopia, and then I'm finished. It issued 2 diaspora bonds in 2008 and in 2011. And actually, 2011 was absolutely fine because it was kind of like basically well structured, and it learned from the failure of the past. And the 2008 one didn't really attract as many capital as it wanted because of too high political uncertainty. So you need to have all of those ingredients in place in order to do this. It's a great way to diversify. It's a great way to keep in touch with your diaspora, but it also needs to be, as I said, structured, coordinated in a way that is not just the only thing that you do with your diaspora. And typically having a ministry or agency for your diaspora and doing constant communication with them is certainly one way that kind of like can lead you afterwards to do those financing.
Thank you, Anne. Another question for you while we listen to Rabah is on local bond markets, or in general raising money locally. Well, there's a sub-question, so would you consider diaspora local markets? Maybe, maybe not. So to differentiate maybe a bit more, and then the question of, do you see in the recovery phase in some of these countries a role for the local, I guess, bond markets or other source of local financing? Rabah, to you on the energy sector, energy enterprises, how do you see these faring during the crisis, and perhaps a larger role in some countries than we commonly see for them?
Yeah, no, so the network industries in general, but specifically the electricity sector is absolutely central to the recovery. We see easily why. And we can't really possibly think of letting them go down. So it's quite central, but at the same time, it's a sector that is a source of important contingent liabilities, and we see that emerging in many countries. And as I mentioned, several countries have allowed deferment of payment. Of electricity and water bills, so these liabilities are likely to emerge on top of a already difficult financial situation. So there, I would argue that the reform should really be about, again, isolating the segment where the distribution segment versus the production segment, where you can have a lot more private sector and both, but of course both should be regulated very tightly. But a difficult situation, a central sector, of course, for the recovery, but also perhaps an opportunity to strengthen the regulator, to make them much more independent, and if needed, also to separate the production segment where a lot more competition can be brought to bear. I also would add that on the broader energy sector, the oil sector is going to be facing quite a bit of a dramatic setting in light of the pullback of FDI, of investment, including by the majors. And this is likely to happen a lot in parts of Africa where extraction costs are high. And given the drop in the oil price, the more severely affected countries would be those with high extraction costs. And in comparison, the Middle East and Saudi and others who have the lowest extraction cost in the world are still, the last time I looked at the FDI and in the sector, they still had FDI flowing from majors investing in the sector on top of Aramco. So clearly, this is the oil and commodity sector are going to be affected. And if you're on a sweet spot and it's cheap to extract and you have easy access to market, you'll be in a better position. But there's going to be a lot of discrimination depending on the extraction costs and transport costs associated with your resources. I'll stop there.
Thank you, Rabah. So we will listen to one question specifically to you. I guess your new position is, does the crisis provide new vistas for research, particularly on Africa? So now that you're responsible for that in the African Development Bank, if you can consider this question, and after Anne and you respond to this, we will wrap up with some final comments, since many of the questions actually converge towards the topics we already discussed. So Anne next, please.
Yeah, so your question was on local markets. Yeah, no, first of all, diaspora I don't consider as local. For me, it's outside. Certainly we could have a debate on this, but I consider it as international. On local markets, those are absolutely key, because actually, so you have, as we said, let's take external debt or international debt. You have the public debt, debt from the multi, all what we discussed, and you have the private debt. And within the private debt, you have the traditional classical loans that you can have with institutions. You can have the bonds as a diaspora one that we mentioned, the green, the social, and so on, and the traditional, much more traditional Euro bonds. And those are kind of like the type of element, but that are international. And what you need and what a country needs in order to fund its economy is to have developed local markets. Why? Because otherwise, banks are the one who kind of like fund the government, which, you know, in itself is not a problem, but they use banking capacity and they use their balance sheet in order to fund government. It's much more and it's much efficient and much better that it's done through investors, and those investors are going to be investors in local markets are going to be local investors, so banks, pension funds, and so on, but also international one, which is the only way to also make those local markets grow. And they are critical to fund the economy. By the economy, it can of course be, you know, SMEs, it can be large companies from those countries, it can be also individuals, but this is the way to actually build and grow an economy in a proper way without having restriction around your own banking system. If we take, it's not in the region, but if we take the case of Lebanon, the banks have been, and there are many issues with Lebanon, but the banks have been financing the state and clearly not been able to do that or not done their job when it comes to funding the economy. Making sure that this is released and they have capital and funds in order to actually fund the real economy and real initiative is absolutely key and can be a huge growth provider. So we definitely need to see those type of things that happen in Lebanon, in other countries, development of local markets. It has to be said that some countries have actually started to develop this well. So it's much more a continuity of effort that have been made so far, and deepening of also some of the rules in order to make some of the bond Euroclear compliant. That kind of like, you know, just takes time to implement. But some of the countries, if not lots of countries, are in the good path or good way in order to do this.
Thank you, Anne. We'll listen to Rabah on research and then some final thoughts if something that we've missed so far in the conversation, so some thoughts that may have come to your mind. But now, Rabah and research, are there some new research opportunities that this crisis provides that we have not experienced before, or not the magnitude that we've seen now? Anything on your agenda is the new chief economist of the African Development Bank? I think this is probably coming from some of your new colleagues.
Yeah, no. So you know, and I'm hoping a lot of the research will be done jointly with you, Simeon, and Anne-Laure perhaps as well. But you know, one thing that I've always been fascinated by, and clearly this crisis should be that opportunity to think big about reform, about, you know, building back better. But one specific area which is of particular interest is the issue of the political economy of execution. And let me take this state contingent instrument. Why are they not emerging? We've been talking about GDP index bond for a long time at the bank, at the World Bank, and elsewhere. Why is it not emerging? You know, there may be some interesting question coming out of this particular lens, because I often get frustrated at the number of very good ideas, but at the little we know of why it's not being done. And interestingly, of the few state contingent instrument I know of, the inflation index bond that was developed by the Treasury, that was developed in the US, was really the result of the voluntarism of the Treasury. And it really took a very, very strong push several times for it to come to fruition. So interesting, interesting case study to try and understand why we're missing that voluntarism, or why is it not coming to focus. And the other topic of great interest is obviously informality. Understand much more the issue that relates to informality, looking at every dimension, both on issues related to the demand side and the supply side. So also on the normative side, thinking about the ways in which is it just about growth, allowing informal worker to graduate, or is there a lot more push to be done on the supply side? And how do we second that so as to have this evolution of capability, so that the economy progress? And around informality, you have tons of interesting topic also on taxation. Is VAT the way to indirectly tax the informal? Is that sufficient? Is there, again, in the taxation of the informal sector, a sort of a wedge between the formal and the informal way in which we treat this sector? Is there a better way to smooth taxation so that we have a better continuum? So around informality and debt, I would say would be my priority topics.
Yeah, thank you very much for that, and I'm sure some new topics will emerge as we go deeper into the recovery, and also as we publish our joint book. So, Anne, Rabah, any final thoughts, comments, something that may have come up in your thoughts as you're going through this, or some areas for future discussions, perhaps, that we don't quite know the answers yet, but maybe the recovery will force us to have a final minute or so each. Anne, first.
Yeah, two points. The first point is that the current debate that is happening at the IMF days and will continue around the debt restructuring and the participation of the private sector, the need of a frame that MD Kristalina Georgieva just highlighted again, is highly, highly interesting, extremely topical, and may well shape also a lot of the discussion that will be happening in Africa. So I think it's a great discussion because it actually is a discussion about value, about sharing the value, sharing the burden. And that's really one of the key themes, not just in Africa, but overall. And I just think we should watch out this debate and take part as much as one can. And the second one, very quickly, is around execution. Because hearing also about a lot of people in Africa, they are saying, oh, we hear a lot of those measures, they're great, big numbers, but where is it actually? So as soon as there is something that is announced, I mean, the importance of execution and the importance of delivering for the people so that they can actually see that the words becomes reality is also something that, I'm stating the obvious, but it seems to have been one of the most consistent feedbacks that we've heard in Africa and that I wanted to share in this context.
Thank you, Anne. Rabah?
So I mentioned it briefly, but the issue of capital flight in the midst of this crisis clearly doesn't signal a lot of nationalism on the part of these those fleeing these countries. So clearly, the issue of capital control is going to be one that is going to be central to discuss. Are these capital control appropriate in light of this capital flight? Should they be put in place? So some have argued that they should be put in place for the longer haul. So lots of issues to discuss at the time when we're trying to find solution to financing. These leakages appear, gigantic, and one needs to act quickly. And we saw that not acting quickly in the case of Lebanon is making the situation extremely complex. And now it's even difficult to tap into the diaspora for a variety of reasons in Lebanon. The other issue, and again, an issue that I touched upon, is the issue of the zombification of firm, a big issue arising in advanced economy. And again, when thinking from the developing countries' perspective, maybe this is a Schumpeterian moment. So the idea of replicating what we see in the advanced world, just mimicking by bailing out a firm that didn't have any capability, is not the way forward. So really using that moment to think much more boldly, given the youth, given the idea that the conservatism in preserving what's there, while we have this young population left behind, is really something I'd like to rethink very hard. I'll stop there.
Yeah. Thank you, Rabah. And it would be interesting in about 6 months to revisit this topic, maybe with us, and we can also invite some speakers who are on the front lines, finance ministers, central bank governors, to see within the next few months how Africa is faring on many of the topics that we discussed. Again, we have a book forthcoming by CEPR, Vox EU, the London School of Economics, African Development Bank in January on this topic, financing the recovery in Africa. So for our participants, please look out for it in mid-January or so. And I should say that the London School of Economics makes great podcasts almost instantaneously of these talks. So please look for that and send it around if some of your colleagues or friends would like to listen to it. And Rabah, thank you again very much for your time. Hopefully this was useful just to organize your own thoughts as well in this rapidly moving environment. We at the London School of Economics appreciate very much your time and expertise. Thank you very much.